Hi, I'm Paul Johnson, Director of the Institute for Fiscal Studies. Welcome to this week's episode of the IFS Zooms in which we'll be looking at the unique challenge of getting the economy going again. I'm going to be talking to Professor Rachel Griffith, Research Director at the IFS, and Rob Joyce, IFS Deputy Director, about the economics of getting us back to work. To deal with the coronavirus pandemic, the government shut down a large part of the economy, forbidding pubs, restaurants and entertainment venues from opening, while discouraging many others from going into work. It has put in place a furlough scheme, the Coronavirus Job Retention Scheme, which has involved it paying the salaries of over 7 million private sector workers at a cost of over £10 billion a month. It's committed to carrying on with that scheme in its current form until the end of July. This and other measures, including a support scheme for the self-employed, were put in place at short notice. They've been hugely effective at supporting employers and workers and ensuring many millions have not lost their jobs. Government now faces the challenge of how to move us safely back to work. When and how fast it does that will of course depend on the medicine and the epidemiology. But how it goes about it will also depend on the economics. So Rachel, one of the first things I want to talk about, which is really crucial in this crisis, is the role of uncertainty. We don't know what's happening at the moment, let alone what's going to happen in the future. And that really does matter for the economics of all of this. But perhaps you could start by telling us, in this sort of circumstance, what do we even mean by uncertainty?
Hi, Paul, and thanks very much for inviting me to do this podcast. It's great to be here. So, exactly. You ask about uncertainty. So the pandemic and also the policy responses of governments have led to a huge increase in economic uncertainty about the future. So this matters a lot because a lot of the decisions that people take are based on what we expect to happen in the future. So when I go shopping, I decide how much toilet paper to buy, in part based on when I expect to be able to buy it again. If I'm going to be able to buy it again next week on my regular shop, then I'm only going to buy a little bit. But if I think it's not going to be there, or if I'm going to not be able to go shopping for several weeks, then I may want to store up and I'm going to buy more. Young people decide whether to go to university and what subject to study, in part based on what kind of jobs they expect to be able to get and how much they'll be able to be paid in those jobs. Firms decide whether to install new machines, whether to open up a new store, or all sorts of investment decisions based on what they expect to be able to sell to people in the future and what they expect the profits to be from those activities. So as you said, this situation has increased those uncertainties enormously.
So we always face some uncertainties. We're always taking decisions under conditions of uncertainty. But what sort of uncertainties are we facing now that are different from normal?
So right now we're facing very high uncertainty about an enormous number of things. So that's what's unusual. It's unusual both the high degree of uncertainty, but also that we're uncertain about a whole bunch of things. We're often uncertain about one thing, what's the weather going to be tomorrow, but not about everything. So right now, we don't know how long we're going to have to socially distance for, what impact that social distancing is going to have on our normal daily activities. Am I going to be able to go to the restaurant tomorrow? Am I going to be able to take the train somewhere? Will there be a vaccine discovered? There's a huge number of uncertainties, and that's sort of what makes this situation unusual. There's also uncertainty about what policies governments are going to implement and how those policies are going to affect me. Again, we always have a bit of that uncertainty, but that's much higher now than in normal times. A recent survey of UK firms called the Decision Maker Panel showed, for example, that in March 2020, COVID-19 was the largest source of uncertainty for about half of firms. So by April, just 1 month later, this had risen to nearly 90%. So almost all firms saying that COVID was the largest source of uncertainty that they faced. That's a very unusual situation. And nearly 60% of those firms said that they expected COVID uncertainty to remain unresolved at least until September, if not longer.
So there's certainly a lot of uncertainty around, much more than usual. Why is it, given everything else that's happening at the moment, why is it that we're particularly worried about uncertainty? Why does it matter?
Yeah, so uncertainty matters for a whole bunch of reasons. So, faced with increased uncertainty about the future, it makes sense for firms to wait to undertake a large number of different types of activities until they're more certain so that they can make a more informed decision. So this means that firms are going to wait to make investments. Do I buy this new shop? Do I install this new machinery? They're going to delay research projects or defer hiring staff until they are more clear and more certain about what the likely path of the economy is going to be. So it might also slow down workers' and firms' decisions to reallocate resources to more productive uses. If I own an airline, am I going to stop flying my planes and shift my activities to something else? People may delay those decisions because they think that there'll be more certainty in the future. So this is what economists call the option value of waiting. And this affects not only firms, it also affects households. So if I'm more uncertain about whether I'm going to have a job tomorrow or how much I'm going to be earning, then I may decide to save more just to be on the safe side. And by saving more, that means that I'm spending less. And so that's going to reduce my own well-being because I'm not buying things that I might get pleasure from. But it also makes it less certain for firms whether I'm going to buy their products in the future. So that sort of increases their disincentive to invest because people are spending less. So greater uncertainty also dampens investments through another mechanism, which is through finance. So if I have some money and I'm potentially going to lend it to someone, but there's greater uncertainty associated with how much money they're going to earn from that increases the risk. And when something's riskier, we usually think that investors want to be paid more to make that investment. So that also means that the cost of finance is likely to get more expensive. So while there's some other effects that work kind of in the opposite direction, we tend to think, and most of the evidence suggests that they're smaller than these negative effects.
Wow. So uncertainty matters for all sorts of things. It's really something that stops people acting. It stops people deciding. It stops household spending. It stops businesses investing. So that's something that really matters right now for the future of the economy. But given all that, is there anything that government can do, given that we do live in a pretty uncertain world?
Absolutely. So, in fact, government does already do a lot. As you said, there's uncertainty in normal times, and a lot of government's activities are addressing those types of uncertainty. So there's tons that the government can do to help both reduce that uncertainty and also help mitigate the effects of that negative uncertainty. So policy generally plays a really important role in reducing uncertainty. For example, if we go back to the survey that I mentioned about these key decision makers in firms, one of the other things they asked firms is about the average effect of the crisis on their sales and investment decisions and employment decisions. And what you see in that is that on average, sales and investments reduced by around 50%, whereas expectations about employment only reduced by around 20%, so by much less. And the difference in these numbers is due to many things, but in large part, it's due to the role of the job retention scheme and other kind of ways that government helps to underwrite the uncertainty and risk of unemployment. So it makes the effect on unemployment much smaller than that on sales and investment. So right now, those types of policies can really help firms and individuals take decisions by helping underwrite the risk. However, policy uncertainty is also a large cause of uncertainty. And in fact, evidence from the US, similar types of surveys in the US of firms suggest that, in fact, policy uncertainty at the moment is one of the most important things. So we know, given the very high level of support that government's giving to people, to households and workers and firms, we know that that's going to be reduced. Inevitably, that's going to have to be reduced in the future. But there's a lot of uncertainty about the timing of that reduction, the scale of that reduction, and the particular form it will take. And that kind of policy uncertainty, it similarly has negative effects on decision making and on people's ability to act. And so whatever the government can do to make statements about the direction that policy is taking or the types of policy reforms and the sorts of timing they're thinking about, that can help to reduce that uncertainty.
So government has quite a big role in itself in providing certainty to households and businesses. Not least, it can be damaging if it's not clear about what itself is trying to do. So one of the things, Rob, that the government has done is to spend an awful lot of money keeping people in a job, or at least being paid through their employer, through the job retention scheme. they'll need to move away from that at some point. How might they think about doing that, and how might we think about the pros and cons of the not well articulated proposals we've seen so far?
Well, I guess it's at the heart of the decisions here about how to withdraw this huge JRS scheme, which we really invented from scratch just a couple of months ago. There's a basic set of trade-offs, which is that on the one hand, if we go on with this scheme for too long or in a form that is more generous than it needs to be, that means obviously the cost to the exchequer remains massive. It's at the moment equivalent, I think, roughly to having another NHS in spending terms. But it also means locking people into their original employer-employee relationships for a very long time, and in some of those cases, it might be better for people to start looking for alternative employment, particularly where their old job might not come back for a while. Or we would in fact want the firms to be thinking about innovating to find a way of making the work safe and productive rather than keeping people on furlough. So the danger of something that goes on for too long and is too generous in some sense is A, of course, the exchequer cost, and B, it sort of slows down some of the adjustments in the labour market which are going to have to happen. Obviously, the danger on the other side is that if it is withdrawn too soon, it could lead to a huge amount more unemployment and the hardship that goes with that, and the potential scarring, kind of long-term career effects that might go with that, and to the, in particular, in some cases, to the destruction of employer-employee relationships, what economists would tend to call matching capital, where the specific relationship between an employer and employee perhaps has gone on for some time and is really very valuable. That person has lots of firm-specific knowledge and so on, and that can get destroyed, even though in the long term it might have been viable, and that's something else we want to avoid. And we want to avoid firms more generally going bust and all the capital they might have built up being wasted if in the long term they might have been viable. So that's the sort of the trade-off, I suppose, at the heart of how we move away from what we currently have. So one thing that government has already said that it will be doing in the August to October period this year is moving towards a cost-sharing model. So that what that means is at the moment, the government will pay 80% of a furloughed employee's previous wage. The employer can choose to top that up, by the way, but they don't have to. Whereas under a cost-sharing model, the government said the 80% figure would still remain in place. So from the employee's point of view, if they're furloughed, that's still what they would get. But they've indicated that there'll be some mandatory contribution towards that from the employer. So the employer and the government would be moving towards a cost-sharing approach. So it's a way of trying to withdraw the furlough scheme gradually. It's a way of trying to, for example, make firms actually weigh up whether the value of an existing relationship with an employee is non-negligible, because now they have to pay something to keep it going. So it forces some decisions, and it will make it less likely that firm and employee relationships that have no long-term future just stumble on for longer than they need to. But obviously, the risk is that it does start incurring more risk of job loss for those whose employers feel that they can't afford the payment, as opposed to if the rate was simply lowered with any employer contribution still voluntary. So in that sense, it prioritises the continued, because the 80% figure remains, it prioritises the continued level of support for those who remain furloughed at the expense of more risk of job loss for others.
And at the moment, it looks like they're going to do this We don't know, but probably similarly for all sorts of different firms. And does that in itself produce risks, given that we know some firms may still be locked down and other firms are perfectly capable of operating?
Yeah, and more generally, the balance of considerations here is going to vary for different kinds of people, for different kinds of firms. And there are probably some decent proxies for how the government might, rough but better than nothing proxies for how the government might try to differentiate according to those kinds of factors. So sector could be one. I mean, there are some sectors where it already seems very likely that really the demand for the product, if you like, won't be there for some time. Something like hospitality. And so we might want to think about that kind of sector differently from a sector where we think that the potential for productive and safe work is coming back, and we want to encourage that to happen. Now, I think, it kind of comes back to a point really about uncertainty as well, actually, because one way of thinking about this is that the government can try to come up with good proxies of ways of distinguishing between these different cases. So, go back to the two kind of cases I was painting just now, where you've got worker one who works for a firm, and let's say they've been there for quite a long time, they've built up a lot of firm specific knowledge that's really very valuable, and if they had to start again with a different firm, they'd be falling back a fair bit in terms of how well they're able to do their job. Or for other reasons, they just really value the relationship they have with their employer, the colleagues they have, or whatever it is. And so for that kind of worker, even if their old work isn't going to come back for some time, it might be worth hanging on for somewhat longer. We don't necessarily want them to sever that match and start looking elsewhere. Whereas it might well be that you've got another worker where actually, the value of the specific relationship they have with their current employer isn't that high. That they work in a restaurant, and if they ended up having to work for a different restaurant, they wouldn't have lost all that much. And it may well be that they could retrain or direct their attention towards some other sector entirely. In those kinds of cases, we're more likely to think that what those people should be doing, rather than waiting potentially many months, if that's what they would have to do, and doing nothing economically productive, they would be better looking elsewhere now. Now, the government is never going to be able to perfectly distinguish between those two kinds of cases. It can come up with some rough proxies, perhaps, like job tenure or even sector, but they're only going to be rough. What it really wants as part of the solution here is for the conditions to be such that people can self-identify to a large extent as being in a sort of type 1 or type 2 person and act accordingly. So if people know roughly how long they're going to have to wait for their old job to come back, well, then they're in a better position to at least attempt to weigh up whether it's worth hanging on because the value of their previous employment relationship is so high, or whether they should try and move on. So it's an example of where getting other policies right, some kind of forward guidance in this case, to the extent that it can be given, could be very helpful, because the government's never going to be able to distinguish between these workers perfectly.
So a pretty tough job for policymakers over the next few months as we move away from the job retention scheme, which we will have to do at some point. As I said at the beginning of this podcast, the scheme is huge, and it has clearly been very effective in the sense that whilst unemployment has risen, it hasn't risen anywhere near as much as it otherwise would have done. But we can expect at least a couple of million people to lose their job over this period, and possibly rather more by the time we start to get back to normal. So when we get to that point, can government do very much to help people get back to work quickly?
I think there are maybe three things that I would think of here. So one is, can it grease the wheels of that kind of matching process, that process of getting people matched up to the right jobs? We've seen an example of where, when so much of this is happening at the same time, it can be really inefficient and slow, and therefore presumably lead to needless hardship with people not getting jobs for longer than they should be not getting jobs for. In the case of the fruit pickers we saw not so long ago, where there were clearly people on some level who didn't have work to do, and there was demand for their labour, and it seemed to take a very, very long time for the market to sort that out, and we ended up with labour shortages for a bit where that would seem unnecessary. Probably particularly a problem in cases where you've got lots of small firms where it just takes longer for them to, because there's the lack of coordination kind of matters more. So can the government help there? I think it could with things like platforms for job posting and matching, at least in specific occupations or sectors. I say perhaps particularly focusing on areas where there are lots of small firms. There are reasons to believe that the market left alone would take a long time to sift through the problem. DWP, the Department for Work and Pensions, it doesn't really have the infrastructure for that at the moment, and it doesn't do a lot of actual sort of active job posting and matching really, and it might not have mattered that much until now, but I think there's a strong case for it trying to do more. I guess another sort of point too would be there are very likely to be areas where even if it gets that right, there are going to be areas, given the amount of dislocation there is, where the private sector vacancies that are popping up just don't match up well with the skill sets of people who are looking for work. And so one thing it could do there is a sort of direct form of intervention in some cases, and actually think of those people as very good candidates to be doing valuable public investment work that will pay off later. If it's not crowding out the private sector, if it can identify where there are limited other opportunities, that would be a great candidate for getting people to do valuable public investment work on our infrastructure, broadband to help people work from home more effectively, whatever it is. So that's another kind of thing that it could do, and I think there is an unusually strong case for that. It requires probably quite good data to actually identify where the best candidates for that are, and it requires planning, as with any public investment, in order for it to be effective and not to be sort of wasteful. So if it wants to do that, it should think about it soon. I think that's another area. The third thing, thinking about these cases where the skill sets of people out of work don't match up well with the skill requirements of new jobs, would be training. We put something out at IFS just earlier today showing that insofar as there's been any recovery in vacancies at all outside of health and social care, it seems to be in occupations that require a fair bit of preparation and training. Anyone can't just go into these jobs straight away, and it'd be interesting to see whether that continues as more vacancies open up. But I think there is a potential role here for the government in helping facilitate or perhaps subsidise training, because the scope for the need for retraining is going to be, I think, unusually large, given the potential for mismatch between skills and the requirements of new jobs.
So both of you have talked a lot about challenges facing the government. We've got they have a role in reducing uncertainty. They certainly have a role in dealing with some of the externalities that Rachel talked about. There's a big challenge about moving away from the Corona Job Retention Scheme, and they can do more work in the labour market, helping people once we start to come out of this, once we do know that we'll have significantly additional unemployment. So those are four huge challenges in themselves. But Rachel, I wonder if there are other things that you think government should be thinking about at the moment.
Absolutely, and they link. One of them links quite closely to what Rob was just talking about. I mean, in terms of dealing with the crisis, lots of large firms are better able to do that in lots of ways than small firms. They probably have greater cash reserves, greater ability to borrow, and also greater ability to deal with what Rob was talking about, the problems in the labour market of matching. So there's really an important role for the government to play in supporting small firms. And, if we look before the crisis, the government had policy aims and long-term objectives at that time, which were boosting productivity, levelling up, so kind of reducing inequality, investing in infrastructure, forging a role as global Britain, and reaching net zero and greenhouse gas emissions. And so I think there's definitely thinking to be done about how the government can both help us come out of this crisis while also helping to achieve those ambitions. Rob talked about infrastructure investment and how that could be targeted at places where there's high unemployment. It could be targeted at investments that help us reach net zero. The government could be thinking about supporting small firms to ensure that we don't end up coming out of this recession with a small number of large dominant firms that both harms consumers but also doesn't lead to a dynamic, growing, productive economy. And so one proposition that's been put out by several leading economists has been to think about creating some kind of investment bank, some kind of Marshall Plan for the future, to have some of those decisions taken not directly within Whitehall departments and really susceptible to the vagaries of the day and to lobbying by large firms, but done slightly at arm's length by a group that's established to think about those long-term issues and integrate them into the short-term responsiveness a bit better.
So that's a manifesto for a really significantly more interventionist government policy than we've been used to. Perhaps you could just take us through a little bit why now is a moment for moving to such a level of intervention relative to what we've done over the last 30 or 40 years.
Well, we've already seen that, though, right? I mean, the level of intervention we've seen in the UK and all other economies basically is an order of magnitude bigger than we've seen recently. And so dealing with this crisis for all the reasons that we just talked through and more even, markets don't function well in this sort of when there's these big, sudden, very discontinuous changes. Markets function very well when we have slow, small changes, and they allow us to adjust to the changing world when changes are small. When changes are very large like this, then you really need governments to intervene to help put the market back into the right place. And there's a little bit true of what's happening with greenhouse gases and with big changes in globalization, big increases in inequality. All of those things have really moved us very far away from the place where normal market mechanisms can get us back to a good situation. And so we really need, concerted effort, concerted policy to put us back onto that trajectory, not forever, but to help the economy kind of reset back into a good place, not a bad place.
So this might mean a quite different policy for quite a while, right across the economic spectrum. Are there other areas, Rob, in the labour market where government should be thinking about intervention?
I guess there's perhaps two ways of thinking about that. I mean, one is this crisis, taken on its own, has shuffled the labour market around so much, closed down whole sectors of some parts of the economy, that the direct effect of this crisis alone is going to be very likely to create much more of a kind of mismatch between the skills that certain people already have and the skills that they might actually now ideally want in hindsight, given the different kinds of jobs that are available. And of course, that's going to partly depend on how persistent or even permanent the impacts are on sort of the viability of different sectors of the economy. We don't know that for sure yet. But that's kind of one. That's one part of the answer. And another part of the answer might be that does this just create a heightened awareness or make us think more than we would have done about the possibility that in future big shocks like this can come along, which change the returns to the skills that people already have, and we want an economy which is more robust to that. It might not be a pandemic next time, it might be something else, or it might be another pandemic. But do we want a system? Particularly, this is relevant for retraining, for training during the adult years after people have left education, for example, a system that is more resilient to big shocks like this, and that can therefore, where the labour market can adjust more quickly to a big structural change.
I suppose one of the things that is going through my mind as I'm listening to both of you speaking about this, at least for a period, very different role for government, is a question about whether we actually have the institutional capacity in the UK to do this effectively, because markets fail, but governments can fail as well. And it's actually a long time since British governments have tried to manage the economy in this way. I don't know, Rachel, if you've got any reflections on whether you think this is something that government could do, or what the risks actually are on the downside of trying to do some of this.
So I think that's a very real thing to be concerned about. I think there's some great proposals out there by very senior people who used to play an active role in government and still do to some extent, about setting up sort of slightly arm's length institutions. So rather than really having it within government, setting up like an investment bank, where there are examples of that in other areas, international investment banks, for example, European investment banks. And so I think that it's really important that we think about that institutional structure and get that right. It is very clear that the government doesn't have all the expertise it needs, and that government officials dealing with the day-to-day business of government aren't necessarily in the best place to take these longer-term decisions. Of course, elected officials need to play a very key role in setting the agenda, but that doesn't mean that they need to be the people that are implementing it in a day-to-day sense. And that there you want more expertise and bureaucratic expertise. And that may be best done at some kind of arm's length, like we have the Bank of England operating slightly at arm's length.
That's an incredibly important distinction. So government can ask for things to happen, it can facilitate things, it can fund things, it can set strategy, but it doesn't actually have to be civil servants in Whitehall who are making the micro level decisions and actually doing the delivery. And what we've learned, I think, from many decades of economic policy is often it's better to distinguish those two things.
Exactly. That's exactly right. And I think this is the classic time to be thinking about setting that institutional structure upright so that we get that right for now and in the future. I think, as Rob said, one of the big questions on the table is, are we going to be experiencing other shocks like this going forward? And if so, can we set up institutions that will make us more robust to deal with them when they come?
Well, I think that's a really important question. I mean, maybe we'll end this podcast on that question, Rob. I mean, what we've seen is the government really playing this extraordinary role as an insurer for employers and employees in a way that it's really stepped back from in welfare policy over the last 70 years, really. I wonder whether there are lessons in this for how we might be thinking about the government and its role in providing benefits and insurance in the face of these kinds of crises.
Well, quite possibly. I mean, it's very noticeable that we had to set up basically from scratch this huge system of earnings replacement, essentially, which is what the JRS is, where other countries already had something much more akin to that already in place. And now, I mean, it's not a cut and dry thing. There are difficulties of relying, for example, solely on some kind of contributions-based system where you pay some money in when you're working, and then you're entitled to some fraction of your earnings later if you fall on hard times. In particular, what do you do then about people who obviously are in need but don't have the requisite contributions history? You still need to supplement that with something more like what we have had now for many years, which is essentially a means-tested safety net. But what we've seen in this crisis is that one of the difficulties about relying on that sort of means-tested safety net is that in a crisis like this, it highlights this, that there are people who could lose their livelihoods, who might not be the kind of people who are used to thinking about relying on the welfare state. They never expected this. They had costs and spending commitments that were commensurate with their relatively decent incomes, and suddenly when they do experience a shock, the kind of replacement that they get, the income replacement that they get from a system like we had, is just not going to be enough to tide them over in some cases, even for a short period. So I think it may make us rethink that. I mean, there are other issues too, like the groups who fall more between the cracks in a crisis like this. This is already getting some attention, but it's now getting even more. Some of the people in more informal kinds of work, the self-employed and other people on the boundary between self-employment and employees. And so having a system that can properly insure those kinds of people, migrants as well. I think that's another set of issues that will probably have a rethink. I mean, it'll be interesting to see how all of this interacts with changing public attitudes and therefore the sort of political economy of welfare policy. With so many people now having experienced the welfare system themselves than was the case before. And even for everyone else just having seen what's happened, they might think rather differently about the role of the welfare system than they did before, as a sort of an insurance mechanism rather than just something that's there to prop up the incomes of a sort of unchanging lump of benefit recipients, which is, I think, how often they're thought of. So there's lots of unknowns about how attitudes will change, and that of course will also shape policy.
I think that's a great example of how the experience that we're all having over this period, the experience that government is having of intervening in a way that it has never done before, the experience many people are having of working at home, the experience that people who never thought they would have done are ending up relying on benefits, could change the political debate really quite fundamentally for a period. And as both Rachel and Rob have said, there's a very good reason for that. There's a very good reason for seeing government being more interventionist for a period, because the market has broken down as a result of the pandemic and our responses to it. There will then again be challenges of withdrawing from that level of intervention, just as we have the challenges of withdrawing from the job retention scheme that we've touched on earlier. We've covered a huge amount of ground today, but for now I think it's probably time to end on that topic. Thank you again for joining us at the IFS Zooms In. We do hope you can join us next week as well, as we continue to unpack the unprecedented effects of this pandemic, because there is far more to cover even than the big set of issues we covered today. If you enjoyed this episode, please subscribe and rate us. And you can always stay on top of our latest work by visiting www.ifs.org.uk. Stay well, and we look forward to speaking to you again soon.